Hello and welcome back to Metty's Digital Classroom, streaming every Tuesday with your favorite digital host, Metty. If you're tuning in for the first time, don't forget to hit that like and subscribe button to join our growing community of tech enthusiasts and digital explorers. And for those returning, a big thank you for your continued support. Remember to share this video with friends who might find it intriguing. Last week, we navigated the intricate world of providing liquidity in DeFi. It was an exciting journey, and if you happen to miss that episode, I highly recommend you go back and check it out. It's packed with valuable insights and is a must-watch if you're keen on understanding the DeFi space. You can find the link to that episode in the description below. And hey, for those who love reading, we've got all this content in blog format too. Check out the links below for more. Today, we're embarking on a new adventure, understanding the cryptocurrency market cycles. Yes, we're talking about surfing the highs and diving through the lows of the crypto market. It's a thrilling ride, filled with ups and downs, much like the waves of the ocean. So strap on your life jackets and let's dive right in. First off, let's lay the groundwork and understand the basics of cryptocurrencies. These digital currencies, secured by sophisticated cryptography, are like hidden treasures in the vast ocean of the internet. Instead of a physical map, you navigate this world with a digital wallet. The backbone of most cryptocurrencies is blockchain technology, a decentralized digital ledger spread across numerous computers worldwide. This decentralization is the unique allure of cryptocurrencies, akin to the siren's song for digital explorers. Now on to the heart of our discussion today, market cycles in crypto investing. Just like the ebb and flow of the ocean, market cycles in cryptocurrencies show patterns of upward trends, bull markets, and downward trends, bear markets, along with periods of sideways movement. Understanding these cycles is essential. It's the difference between knowing when to surf, float, or stay out of the water altogether. In a bull market, you'll witness rising cryptocurrency prices and a generally optimistic mood. It's like finding a treasure on the beach. Everyone's excited and stories of huge gains are common. Conversely, a bear market is marked by falling prices and a more somber mood, akin to a cloudy day at sea. But remember, savvy sailors see this as an opportunity to buy low, waiting for the next big wave. Why are these cycles important, you ask? Well, in the unpredictable ocean of cryptocurrencies, riding the right wave at the right time can mean smooth sailing or a capsized venture. And we all know capsizing is not fun at all. Let's delve deeper and define these market cycles in the crypto world. Think of a market cycle as the life journey of a cryptocurrency's price, complete with stages of growth and decline. These cycles are influenced by factors like investor psychology, market sentiment, technological advancements, and sometimes just plain hype. It's the heartbeat of the crypto market, not always predictable, but with a pattern that can be studied and understood. We'll break down these cycles into 4 main phases, so stay tuned as we embark on this part of our journey. But before we do, remember to hit that like button if you're finding this information useful, and subscribe for more such content. Your engagement helps us reach more curious minds like yours. In our next section, we'll explore each phase of the crypto market cycle in detail, so don't go anywhere. We're just getting started on this exciting voyage through the highs and lows of the cryptocurrency market. Stay with us, and let's decode the mysteries of these digital waves together. Now let's steer our ship through the mysterious seas of market cycles in the crypto world. A market cycle in crypto is like the life cycle of a sea turtle, but instead of hatching and returning to the sea, we're talking about prices rising and falling. These cycles are influenced by a myriad of factors, including investor psychology, market sentiment, technological developments, and sometimes just the good old-fashioned hype. It's the heartbeat of the crypto market, and like any heartbeat, it has a rhythm that, while not always predictable, has a pattern that can be studied and understood. Let's break down these cycles into 4 main phases. Imagine you're captaining a boat, and these phases are the different stages of your journey at sea. Picture a calm sea where the water is still and the mood is a bit gloomy. Prices are flat or slightly declining. But here's where shrewd investors start quietly buying or accumulating assets, believing they're worth more than the current market price. It's like finding a rare shell on an empty beach, Not everyone sees its value, but those who do know it's a gem. Hold on to your hats, folks, because things are about to get breezy. Prices start to rise, sometimes rapidly. This phase is fueled by positive sentiment and increased investment. It's the party boat phase, where everyone wants to join in the fun. The term bull market comes from the way a bull thrusts its horns upward, a perfect metaphor for the upward trajectory of the market. Now, imagine reaching the peak of a giant wave. This is the distribution phase. Prices are high, and the savvy investors start to distribute or sell their assets to lock in profits. It's a bit like musical chairs. Everyone's enjoying the ride, but the smart ones are eyeing a safe spot for when the music stops. And then comes the bear. Prices start to fall, sometimes as rapidly as they rose. The term bear market is thought to come from the way a bear swipes downwards. This phase can be as intimidating as facing a real bear, with investor confidence waning and prices plummeting. But remember, it's not all doom and gloom. For the astute investor, this can be a time to buy quality assets at lower prices. Let's look at some real-world examples to illustrate these cycles, focusing on Bitcoin's journey from 2015 to 2021. After the 2014 to 2015 bear market, Bitcoin stabilized around $200 to $300. This period marked a quiet accumulation phase, with savvy investors buying in anticipation of growth. The bull run began in 2016, with Bitcoin's price gradually rising from around $400 to $1,000 by the end of the year, and reaching nearly $20,000 by December 2017. After hitting its peak, Bitcoin's price fluctuated wildly, with significant sell-offs indicating distribution as investors took profits. The bear market set in by the end of January 2018, with prices dropping below $10,000 and bottoming out around $3,200 by December. Post-crash, Bitcoin entered another accumulation period with prices ranging from $3,500 to $7,500, showing steady but slow growth. Triggered by the pandemic, Bitcoin's price soared from about $5,000 to an all-time high of over $64,000. This period saw high volatility and a gradual decline in prices, with sharp sell-offs and recoveries. Beginning around June 2021, Bitcoin entered a bear market characterized by volatility and a general downward trend. Now let's hoist our sails and delve into identifying the different phases of the crypto market cycle. Just like a seasoned sailor reads the sky and sea to predict the weather, a savvy crypto investor needs to interpret market signs to navigate these turbulent waters. So grab your compass and let's start exploring. Imagine you're at the beach, and it's the calm after a storm. That's the accumulation phase in the crypto market. It's a bit like trying to spot a dolphin in a calm sea. Tricky, but not impossible. Here's what you should look out for. Stabilizing prices. After a roller coaster of a decline, prices start to flatten out, much like the sea settling after a storm. This is a sign that the market might be finding its footing. Low trading volume. The market quietens down with fewer trades happening. It's like a beach in the off-season. Peaceful, but not much action. Skeptical sentiment. The general sentiment is still bearish. People are cautious, nursing their wounds from the bear market. It's like swimmers hesitating to dive back in after a jellyfish sighting. Now let's talk about the bull market. It's like a beach party starting to come to life, with music and excitement in the air. Here are the signs to watch for. Increasing trading volume. More traders join the market, increasing the trading volume. It's akin to more boats appearing on the horizon, ready to join the party. Rising prices. Like the tide rolling in, prices start to climb steadily. This is a clear sign that the market mood is changing. Positive news and sentiment. The market starts buzzing with good news, and the overall sentiment swings to optimism. It's like the forecast promising sunny, perfect beach days ahead. The distribution phase is elusive, like trying to spot a rare bird in the sky. This is when the experienced investors begin taking profits. Keep an eye out for these signs. High trading volume with price stagnation. There's a lot of trading happening, but prices aren't climbing. It's like a beach that's too crowded, leaving little room for movement. Extreme optimism and hype. Everyone's overly enthusiastic, predicting endlessly rising prices. It's like a beach party where everyone thinks the fun will never stop. Unsustainable price increases. Prices soar too quickly, akin to a wave that's grown too large and is about to crash. Finally, we have the bear market, as inevitable as the tide ebbing away. Here's what signifies its arrival. Downturn in prices. Prices begin to fall, sometimes quite sharply. Think of it as the dark clouds rolling in over the beach. High trading volume leading to sharp drops. Initially, there might be a flurry of activity, but it quickly leads to steep price drops. It's like a squall hitting unexpectedly. Negative news and sentiment. The news turns sour, and fear takes over. It's like seeing storm warning flags being hoisted up at the beach. Understanding these phases is crucial not just for surviving, but for thriving in the crypto market. It's about knowing when to swim, when to surf, and when to just sit on the beach and watch the waves. But remember, while these signs can guide us, the crypto ocean is always changing, and surprises can emerge from the depths. Now, we'll dive deeper into the strategies for navigating these market cycles. And as always, don't forget to like, subscribe, and share this video. Your support means we can keep bringing you more content like this. Let's hoist the sails and delve into the fundamental drivers of crypto cycles. These are the undercurrents and gusts of wind that can either propel your crypto ship forward or send you spiraling into a whirlpool. So grab your compass and let's explore these unseen forces that move the markets. First on our map is the Bitcoin halving. This event is like a rare celestial alignment, happening only once every 4 years. That's even less frequent than the Olympics. During the halving, the reward for mining new Bitcoin blocks is cut in half, effectively slowing down the rate at which new Bitcoins are created. Imagine if a central bank suddenly decided to print half as much money. That's the halving for you. Why is this important, you ask? Well, it's all about supply and demand. When the supply of new Bitcoins dwindles and demand stays the same or increases, prices can surge. It's like the last lifeboat on a sinking ship. Suddenly, everyone wants a spot. Next, let's catch the wind of technological innovations. These are the driving forces that make cryptocurrencies more practical, secure, and appealing. Imagine smart contracts, Layer 2 scaling solutions, and interoperability improvements. They're not just tech jargon. They're the winds that fill the sails of the crypto world. Take smart contracts on Ethereum, for instance. It was like discovering a new trade route in the age of exploration. These innovations open up new possibilities, attract new investors, and enhance the utility and value of cryptocurrencies. Navigating the regulatory waters, a task not for the faint-hearted. Regulations in the crypto world can be as unpredictable as the sea. Positive regulations like legal recognition of cryptocurrencies can be a tailwind, boosting the market. However, restrictive policies like trading bans or banking restrictions can capsize the market faster than you can say, ahoy. It's a bit like sailing in international waters. Sometimes you're free to roam, and other times you're dodging pirates, and not the charming Jack Sparrow kind. Now let's look at global economic events. Remember, cryptocurrencies aren't isolated islands. They're part of the global financial ocean. Economic crises, inflation rates, and monetary policies in major economies can send ripples through the crypto market. When traditional markets hit rough seas, some investors see cryptocurrencies as a safe harbor, a digital gold, if you will. Others might pull their sails down and wait out the storm. It's all about gauging the weather and making your move. Lastly, we must consider the media and public perception. The crypto market is incredibly sensitive to news and public opinion. Just like the sea shanties of old, news today, whether tweeted, blogged, or vlogged, can rally the crypto crew or spread doom and gloom, swaying the market in its wake. Understanding these fundamental drivers is crucial for any crypto investor or enthusiast. They're the currents that guide the market's journey, the winds that can fill your sails or challenge your course. You're still sailing with Metty in Metty's digital classroom, where we're charting the complex waters of Bitcoin market cycles. As we continue our journey, remember to like, subscribe, and share this video. It helps keep our educational ship afloat and sailing smoothly. Now, let's set our sights on charting the map of Bitcoin's market cycles using some trusty indicators. Think of these indicators as your crypto compass, guiding you through the sometimes stormy, sometimes serene seas of Bitcoin trading. We'll delve into two major Bitcoin macro cycle indicators to help steer our trading ships. Imagine the hash rate as the heartbeat of Bitcoin's blockchain. It measures the computational power used to mine and process transactions. A strong, steady heartbeat suggests a healthy network, much like a well-maintained ship ensures a smooth journey. Network health. A rising hash rate indicates increased security and investment in the Bitcoin network. It's often a sign of bullish sentiment, like seeing more ships joining a thriving port. Correlation with price. Historically, there's been a correlation between hash rate and price. A falling hash rate can be a distress signal, like a lighthouse warning of potential storms ahead, potentially preceding a drop in price. Now let's talk about the stock-to-flow model. Think of it as a treasure map, predicting Bitcoin's price based on its scarcity. It compares the total stock, the amount of Bitcoins in existence, to the flow, new Bitcoins being produced. It's like measuring the rarity of a precious gem. Predicting price. The S2F model forecasts Bitcoin's future price based on its decreasing supply and increasing scarcity over time. It's akin to predicting the future value of a rare gem. Long-term trends. This model is best used for long-term predictions. It's not a daily trading map, but more like a guide for a long voyage across the seas. And a quick note to our viewers. There are multiple technical analysis indicators that can help decide on Bitcoin price movements, and we might just do a separate video on that. If you're interested, let us know on our social channels or in the comments below. Remember, while these indicators can be incredibly useful navigational tools, they're not crystal balls. They're aids to help you make informed decisions on your trading journey, much like a compass, and a map assists a sailor in navigating the seas. Each phase of the crypto market cycle offers unique opportunities, and like a skilled captain, knowing how to navigate these waters can make the difference between a treasure chest and a sunken ship. So let's hoist the sails and delve into strategies for each market phase. Patience is key. The accumulation phase is akin to fishing. It requires patience and calm. Prices are stable or slightly declining, and the market sentiment is generally low, the perfect time to cast your line. Dollar cost averaging, DCA. This is the time to gradually build your position. DCA involves regularly buying a fixed dollar amount of a particular cryptocurrency, regardless of its price fluctuations. It's like adding planks to your ship slowly, ensuring it's sturdy for the journey ahead. Research and select quality assets. Focus on cryptocurrencies with strong fundamentals and long-term potential. It's akin to choosing a sturdy ship that can withstand future storms. Stay alert. In a bull market, prices rise rapidly. It's exhilarating, like catching a strong wind in your sails, but it can also lead to irrational decisions. Take profits strategically. Don't be afraid to take profits on the way up. Consider selling a portion of your holdings at predetermined price targets. It's like dropping off some cargo at ports along the way for a good profit. Keep an eye on market indicators. Utilize tools like the Relative Strength Index and moving averages to gauge when the market might be overheating. It's like keeping an eye on the weather forecast while at sea. Recognize the signs. Look for high trading volumes with little price movement and increased market speculation. It's like spotting turbulent waters ahead. Rebalance your portfolio. This might be a good time to shift some of your holdings into more stable assets, like moving cargo to balance your ship in rough waters. Set stop-loss orders. These orders can help protect your profits and limit losses if the market starts to turn. Think of it as having a lifeboat ready, just in case. Buy the dip, but carefully. Bear markets may offer opportunities to buy quality assets at lower prices. However, be cautious and do your research. It's like diving for sunken treasure. Rewarding, but not without risks. Consider short selling. For the more experienced traders, short selling can be profitable in a bear market. It involves selling an asset you've borrowed, then buying it back later at a lower price. A bit like a savvy merchant buying goods at a lower price to sell them later. Stay informed and don't panic. Keep an eye on market news and trends, but don't let fear guide your decisions. Bear markets, like storms, eventually pass and the seas become calm once more. Each phase of the market cycle presents its own challenges and opportunities. Like a captain navigating through different seas, understanding these phases and adapting your strategies accordingly can lead to a successful voyage in the unpredictable waters of cryptocurrency trading. Let's dive into the final leg of today's adventure, embracing the uncertainty. In the world of cryptocurrency, the only constant is change. Prices rise and fall like the ocean tides, sentiments shift like the winds, and new technologies emerge like undiscovered islands. Embracing this volatility, rather than fearing it, is key to successfully riding the crypto wave. It's like learning to surf. You need to move with the waves, not against them. Staying informed. Keeping abreast of the latest developments, news, and trends in crypto is crucial. The crypto world moves at the speed of light, and being well-informed can help you navigate these waters more effectively. It's like having an up-to-date map and a reliable compass on this digital sea voyage. Balancing risk and reward. Risk management in crypto trading is like balancing on a surfboard. It requires skill, patience, and a keen sense of the environment. Employing strategies like using stop-loss orders, diversifying your portfolio, and not investing more than you can afford to lose are all crucial for a sound risk management strategy. It's about finding that sweet spot between riding the wave and not wiping out. Adapting to market phases. Different market phases require different strategies. Just like a captain adjusts the sails for different winds, recognizing these market phases and adapting your approach can help maximize gains and minimize losses. It's about being flexible and responsive to the changing conditions of the crypto seas. Long-term perspective. It's easy to get caught up in the immediate ups and downs, but maintaining a long-term perspective is vital. The crypto market, still in its relative infancy, is evolving and growing. Beyond the hype and despair, there lies a horizon full of potential and discoveries. Continuous learning. The crypto world is not just about trading and investing, it's a rapidly advancing field teeming with new technologies and applications. Staying curious and continuously learning is part of the journey. It's like being a lifelong explorer, always seeking new knowledge and understanding. Community and support. Engaging with the vast and diverse crypto community can be incredibly rewarding. Whether online or in person, connecting with fellow enthusiasts offers support, insights, and fresh perspectives. And remember, sharing your own experiences and knowledge not only helps others, but reinforces your own understanding. Teaching, after all, is the best way to learn. As we conclude today's digital voyage, remember that riding the crypto wave is about enjoying the journey as much as it is about reaching the destination. The world of cryptocurrency is exciting, challenging, and brimming with opportunities. Whether you're a seasoned trader or a curious newcomer, there's always more to discover and learn. So keep your sails ready and your compass handy. The crypto seas are vast, and there are many more adventures to be had. Until our next journey together, stay curious, stay cautious, and keep riding the wave. Thank you for joining me in Metty's digital classroom. Safe travels, and I'll see you on the next tide.